This video is for educational and informational purposes only and should not be considered financial advice. This is part 3 of a 3-part value investing analysis of Eli Lilly. In this part, we'll determine what the company is actually worth by looking at key valuation metrics. A great business is not always a great investment. Valuation ultimately determines whether a stock is an attractive investment or not. So let's now look at Eli Lilly's valuation metrics, starting off with the PE ratio. The PE ratio shows how much investors are willing to pay for each dollar of a company's earnings. It measures the relationship between a company's share price and its earnings per share and reflects expectations about future growth, risk, and profitability. To calculate it, we divide the current stock price by trailing 12-month earnings per share. The stock price has recently been around $1,000, while earnings per share over the trailing 12 months has been $28.15. That gives us a PE ratio of 35.5. In other words, investors are currently paying $35 for every $1 of Lilly's earnings. Over the past 5 years, Eli Lilly's annual average PE has ranged from 34 in 2021 to 96 in 2024, reflecting a dramatic expansion in valuation driven by rising growth expectations. Temporary spikes above 100 occurred during periods of peak enthusiasm around GLP-1 driven earnings forecasts. A PE of 35 is clearly elevated and reflects strong growth expectations. Whether that is justified depends entirely on Lilly's ability to deliver sustained earnings growth. For a high-quality business with exceptional returns on capital, a high multiple can be rational, but it leaves little room for disappointment. The PE ratio gives us a quick sense of whether the business appears cheap or expensive relative to its current earnings, but it does not tell us whether the valuation is justified. When we move on to the discounted cash flow model to estimate intrinsic value, we will also analyze what annual growth rate is required to justify the current share price. The next valuation metric is price to book value. It's calculated by taking stock price divided by book value. Notice how price to book value is circa 29. This means that Eli Lilly currently trades at roughly 29 times book value. For a bank, that would be extreme, but as mentioned earlier, for an asset-light pharmaceutical company driven by intangible capital, it tells us very little about intrinsic value. On top of that, aggressive share buybacks have reduced equity over time, mechanically inflating the price-to-book ratio. So while 29 times book value sounds extreme, it does not tell us much about intrinsic value in this case. The last couple of years, it has been between 28 and 49. At last, we need to find Eli Lilly's intrinsic value. To do that, we are using a discounted cash flow model. The idea behind a discounted cash flow model is actually quite simple. We estimate how much cash the company will generate in the future and then calculate what those cash flows are worth today. First, we need to find base year of free cash flow, which is our starting point. Over the past 3 years, operating cash flow has increased significantly, but capital expenditures have grown even faster. Operating cash flow has grown by 30% annually, while capital expenditure has increased by 62% annually. If we simply average the last 3 years of free cash flow, we would severely understate the company's true earnings power. That's because the most recent years include peak expansion spending. Averaging the last 3 years would give us a free cash flow of $4.8 billion. Instead of averaging distorted numbers, we normalize operating cash flow and adjust capital expenditures to reflect a steady state level. Before we build a proper discounted cash flow model, we first need to determine the company's sustainable free cash flow. In other words, the level of cash generation the business can maintain going forward. We start with operating cash flow. In 2025, Eli Lilly generated $16.8 billion in cash from operations. However, we cannot simply subtract the current year's capital expenditures and use that number directly, because the company is currently investing heavily in new production capacity. These elevated investments or growth capital expenditure not maintenance capital expenditure. So instead, we estimate what the business needs to spend to maintain its current operations in a steady state. Historically, before recent expansion phase, CapEx were around $1 to $2 billion per year. But the company is significantly larger today, so we use a more conservative maintenance estimate of around $5 to $6 billion. When we subtract that from operating cash flow, we arrive at approximately $11 billion in normalized free cash flow. That is the figure we use as our base year free cash flow in the discounted cash flow model. Now let's talk about one of the most important assumptions in our discounted cash flow model, the growth rate. For the first 5 years, we assume a 15% annual growth rate in free cash flow. Because Eli Lilly is currently in a structural growth phase, revenue has been accelerating significantly, driven by GLP-1 products, strong demand, and operating leverage. Recent results show revenue growth above 30% and earnings growing even faster. However, while recent growth has been extraordinary, we should not assume that 30% growth continues for a full decade. That would be unrealistic for a company of this size. So instead of extrapolating peak growth, we choose a disciplined but still robust 15% growth rate for the next 5 years. This reflects continued expansion in obesity and diabetes markets, scale in production capacity, and strong pricing power, but without assuming perfection. For years 6 through 10, we reduce the growth rate to 10 to 12%. The reason is simple. As companies become larger, growth naturally slows. Markets mature, competition increases, and law of large numbers effects begin to apply. Even if Eli Lilly continues to perform well, sustaining 15% plus growth indefinitely becomes increasingly difficult as the revenue base expands. Therefore, we assume a gradual normalization toward a still strong but more sustainable 10 to 12% annual growth rate in the later years of the forecast period. It's also worth noting that this assumption is broadly aligned with analyst consensus. Current consensus estimates point to approximately 13 to 23% annual revenue growth over the coming years. So our assumption of 15% growth in the first 5 years sits comfortably within that range. It's neither overly aggressive nor overly conservative. And by reducing growth to 10 to 12% in years 6 through 10, we are simply reflecting the reality that growth tends to moderate as the revenue base expands. Now that we have our growth rate, we need to estimate the terminal value, the value of the business at the end of the 10-year forecast period. I use an exit multiple based on price to free cash flow. We estimate what multiple investors might reasonably be willing to pay for the company's free cash flow at the end of the forecast period. Historically, Eli Lilly's price to free cash flow multiple has traded well above average. In recent years, it has often ranged significantly higher than typical mature pharma peers. However, today's elevated multiple reflects current growth expectations and market sentiment, not a structural long-term norm we can reliably assume 10 years forward. While I typically apply a 10 to 15x multiple for mature businesses, Eli Lilly's structural growth profile, high return on invested capital, and durable competitive advantages justify a modest premium. Therefore, I apply a 17x terminal multiple. With this information, we can calculate the growth in free cash flow over the next 10 years and calculate the terminal value. We start off with our base year of free cash flow and apply a 15 and 10% growth rate to the free cash flow. This gives us $35 billion and $632 million of free cash flow in 2035. And multiplying that with 17 gives us a terminal value of $605 billion and $751 million. Then we need to set a discount rate. Because of the risk involved in stock investing, I always want at least a 10% discount rate. So we take our future cash flows and discount them back to today. And we do the same with our terminal value. Adding all the discounted cash flows plus our terminal value gives us an enterprise value of $365 billion and $203 million. This is the present value of our future cash flows. Enterprise value includes debt. To find equity value, we therefore need to subtract net debt from enterprise value. After subtracting $36 billion of net debt, we arrive at an equity value of $328,829 million. To get intrinsic value per share, we divide equity value by diluted shares outstanding. That gives us an intrinsic value per share of $366. So if our calculation is correct, $366 is the fair value for Eli Lilly stock. If you want a margin of safety, this next table shows what stock price we would want at different margins of safety. Let's say you want a 20% margin of safety. That would mean that the stock price would need to fall to $293 before buying, and we are a long way from that. Over the last couple of months, the stock has generally been trading at around $1,000. Let's say we buy the stock at $1,000 and want an annual return of 10%. How much does Eli Lilly have to grow in the future to justify this stock price? The company would need to grow at an average annual rate of about 26% for the next 10 years. I'm not saying that this is impossible, but it is extremely rare for large companies to sustain growth above 25% for an entire decade. It can happen, however, when companies introduce truly revolutionary products. A good example is Apple during the iPhone expansion. These are the growth rates for Apple from 2009 to 2015. So it is possible to see growth rates above 26%, but in Apple's case, this was one of the strongest growth periods for a mega cap company ever. Now let's assume instead that we buy the stock today at $1,000 and that our growth assumptions of 15 and 10% over the next 10 years turns out to be correct, and that the stock trades at fair value in 10 years. In that case, our average annual return would actually be -1. This shows the importance of not overpaying for companies. Even if the company grows at a solid 10 to 15% over the next decade, paying 3 times intrinsic value means you may not earn a return on your investment. Analysts currently expect Eli Lilly to grow earnings per share by roughly 17 to 22% per year over the next 5 years. If growth slows to around 10 to 15% in the following 5 years, which would still be very strong for a company of this size, the picture looks quite different. At today's price, my discounted cash flow model suggests Eli Lilly would need to grow about 26% per year for an entire decade to deliver a 10% annual return. That is significantly higher than what analysts are currently expecting. So in conclusion, Eli Lilly may continue to be a fantastic company, but at the current stock price, the expectations are extremely high. Whether the stock turns out to be a good investment will largely depend on whether the company can deliver the extraordinary growth that the market is currently pricing in. That is a judgment you'll need to make for yourself before buying Eli Lilly stock. You should always do your own analysis before investing in a company. As always, this is not financial advice. These are simply my own assumptions and calculations. Let me know in the comments what growth rate you think Eli Lilly can realistically achieve over the next decade. If you enjoyed the analysis, consider subscribing for more deep dives like this.